Alright Canadians, it's time to talk about one of the most debated things that I see online all the time, which is, should you invest in VFV, the S&P 500 ETF that everyone seems to love, or should you stick it out with one of the EQT all-in-one ETFs? If you've spent any time online looking at financial content, then you know that every single Reddit thread, Instagram or TikTok video, and every new beginner investor is asking the question, should I buy VFV because it's done so amazingly well? And yes, VFV has done amazingly well, but performance alone doesn't tell the whole story. Whether or not you should invest in VFV is more about what type of investor you are, how much work you want to do, and whether or not you're okay with the risks involved and understand all the risks involved with investing in VFV. So today, we're going to get into the details. We're going to find out if VFV is all it's cracked up to be. By the end of this video, you'll understand exactly what VFV invests in, how the all-in-one EQT funds work, the differences between those funds and diversification, currency risks, taxes, performance, and of course, which fund is best for you to invest in for the long haul. This is not a quick hype video. This is a full breakdown with all the details and everything you need to know. So let's go. So let's jump right in and start with VFV. If you're unfamiliar, VFV is Vanguard's S&P 500 ETF listed in Canada. It holds the 500 largest companies in the US, so you'll own companies such as Apple, Amazon, Nvidia, Microsoft, and all the other big names as well. So in other words, it's basically the US stock market all wrapped up into one fund. It's simple, it's clean, it's powerful, and it gives you direct exposure to the top companies in the US. As for performance, the S&P has historically crushed it, and VFV does a great job of tracking the S&P 500, and it does so with minimal fees. The MER on VFV comes in at just 0.09%, which makes it extremely affordable. And not only that, but over the last decade, the annualized return on VFV is over 15%. So with that being said, it's no wonder that VFV has become so popular amongst Canadians. It's straightforward, it's low cost, and it gives you access to that powerful US growth. However, it's not all roses. VFV is not globally diversified. That means no Canada, no international, there's only US stocks within there. So that means if the US economy slows down, US profits start sinking, or even if the US dollar weakens, that means that your portfolio, it's gonna take a hit. It's also worth mentioning that about 30% of VFV is invested in just 5 companies. So that's a pretty big concentration. Now, let's look at the EQT family of ETFs. So there's 4 main ones here that I'm going to talk about, which are XEQT by iShares. We've got VEQT by Vanguard. There's ZEQT by BMO. And of course, there's FEQT by Fidelity, which is a little different than the other 3 because it does have a small portion allocated to Bitcoin, and the other 3 do not. If you're unfamiliar with these funds, these are called all-in-one equity solutions or all-in-one ETFs. So they hold a mixture of stocks from all around the world, and they're generally low cost and they rebalance automatically for you. So it's essentially one nice package wrapped into one, just like VFV, but with a lot more diversification all across the world. These 4 funds are also similar in their weightings, but generally, you can expect that with one of these all-in-one equity solutions, that you'd have about 45% allocated to the US, about 25% allocated to Canadian stocks, 20% to international stocks, 10% for emerging markets, and then of course the Fidelity Fund, FEQT, as I mentioned, will have a small portion allocated to Bitcoin. Now, all of these funds have a low MER as well, usually in the range of 0.2 to 0.25%. It is slightly higher than VFV, but there's a reason for that. With these all-in-one equity solutions, there's multiple layers of ETFs, So they simply cost more because they have more assets that they have to manage and they have to rebalance automatically for you. But you do get that diversification bonus that VFV is lacking. So let's talk about diversification because it always seems to come up in the finance world. Why is it so important? Here's why. Let's imagine that it's 25 years ago and the year is 2000 and the dot-com crash just happened. If you were only invested in the US, so in a fund like VFV, your portfolio would have essentially gone nowhere for the better part of, say, 10 years, give or take. However, during that period of time, emerging markets and some Asian countries were actually doing quite well, and they really outperformed the US over that period of time. And that's why that's important, because anyone who owned the whole world market at that time would have done much better over that decade than anyone who was solely invested in the S&P 500 or US stocks only. That was 25 years ago, but who's to say that that can't happen again? I mean, right now, people are shouting that we might be in an AI bubble, and if that's true and the bubble pops, then you're going to wish that you weren't invested 100% in the US, because that's going to hurt. The US has dominated the last decade, but that doesn't mean that's always going to be the case. And diversification is not about chasing returns, it's about mitigating your risk all across the board. And that's exactly what these EQT funds are doing. They're spreading your investment across many different countries, many different sectors, sizes of countries. They're giving you access to a broader range and spectrum of companies so that you're not invested solely into one economy. And diversification isn't the only thing you should be worried about. You also have to factor in something called currency risk. So VFV is listed in Canada and you can purchase it using Canadian dollars. However, it's an unhedged product. So that means that if the value of the Canadian dollar goes up against the US dollar, you're actually going to lose money. It's going to drag down the returns of your investment. The EQT funds also have that US currency risk, but it's a lot smaller. The reason being is because we've got all these other countries and currencies all intertwined and mingled into these funds, and that just kind of smooths out any of the currency risk over time. I do want to point out that I am aware that there is a currency hedged version of VFV. I believe it's VSP, but don't quote me on that. However, I am against investing in hedged ETFs, and I'll tell you why. The main reason is because hedging costs money, okay? Hedging is not free. So when you buy an ETF that is hedged, these managers are actively hedging your currencies for you, and there's a cost tied to that. That will drag down your returns. Not only that, but just because you're hedging your currency does not mean that's the right thing to do. For example, if you were to buy the hedged version of VFV and the Canadian dollar actually weakened against the US dollar, well, now you're just paying extra costs when you would have made more money by just not doing it. So because you can't tell the future and you don't know which currency is going to be more powerful later on, there's no reason to pay for a hedged product. All right, moving on. The next thing I want to talk about is everyone's favorite, taxes. So I've actually received some comments on some of my other videos regarding this, so we're going to jump in and take a look. There's a lot of confusion between the US-Canada tax treaty and which investments are actually able to get a benefit and which are not from America. So if you hold VFV in a TFSA, you're going to have to pay the 15% withholding tax. Even when you get a dividend paid out by VFV, that 15% withholding tax has already been taken. So the IRS already has that money. The dividend that you receive is net of that. You just don't see it. EQT funds also have that US exposure, so they do also have to pay that withholding tax. However, because a larger portion of the investment is invested in Canada, along with some other countries, the same thing applies to the currency, that it's smoothed out over time. So you will have those tax implications, but they're going to be a lot less in the EQT funds than they would in a fund like VFV, which is 100% US. Another point to consider is that a lot of people think if you're holding a US asset in an RRSP that it's automatically tax exempt from that withholding tax due to the treaty. But that's not true. So if you're holding a US listed security in US dollars, then yes, that applies. But because VFV, although it invests in US companies, is still Canadian listed in Canadian dollars, then that treaty does not apply and you will not get that tax advantage. If you were holding something like VOO, which is Vanguard's S&P 500 ETF denominated in US dollars, if you were holding that in your RRSP, then yes, the tax treaty would apply. You would not have to pay the withholding tax, but because it's in US dollars, you of course would have to convert your Canadian dollars into US dollars, and that might not be the right move because you're probably going to have to pay fees to do that. And once again, nobody knows which currency is going to come out on top when it's time to retire and time to withdraw your money and sell your assets. The bottom line here is that taxes are not necessarily something that you should be concerned about. That's really getting into the nitty-gritty of it all, but it is still something that you should be aware of just in case. Okay, now let's talk about the part everyone wants to know, which is the performance. If you look at the last 5 years, VFV has actually outperformed these EQT funds by about 25% or so, which is actually a huge amount. It's not something to take lightly. The reason for this is that the US has really been on a tear with all of these AI advancements and this sort of tech uprising that we've had. And you know what? A lot of people have been talking about the US dollar lately, but if we look back, the US dollar actually has been pretty strong, and we can see that in certain currencies as well. And that's the reason that VFV has actually done so much better over the last 5 years than those EQT funds that I mentioned. Here's a screenshot of VFV over the last 5 years, and we can see the return is over 103%, which is obviously a great return. If we flip over to this screenshot of XEQT, we can see that the return over that same 5-year period is just over 77%. So this does prove that over the last 5 years at least, VFV has done better than XEQT. So once again, it's a noticeable gap, but it's not the whole story. We know that the US dominated for the last 10 years, but what if the future decade is dominated by someone else, such as international markets or emerging markets? Then these EQT funds could catch up or even blow right past VFV and the US market as a whole. And that's what these EQT funds do, is they search for balance. They don't chase what's hot right now, and what's been hot for the last 10 years, that's the US market. One of the biggest advantages to these EQT funds as well is the automatic rebalancing, which I mentioned before. So if there is a sector, so for example, in this case, the US markets have been on fire, then these ETFs are going to sell some of that portion of the investment, and they're going to reallocate it to the other portions of your investment. So they're slowly going to skim off the top of the highest performing sectors or geographical areas, and they're going to redistribute to other sectors and other geographical areas that may not have been doing as well. Now, if there's a rotation or a shift in what is doing well, then it will go back. So that keeps your entire fund in a balance and in check to make sure that your investment doesn't go too far one way or too far the other way, and you're not invested too heavily in any one area. If you only own VFV, there's no rebalancing. Everything is 100% invested in the US. So if you did want to rebalance, well, that's something that you'd have to do yourself. It wouldn't be automatic. And to be real, nobody's going to do that. Once they own VFV and they see that it's going up and up and up, they're not going to have the capacity to sell some of that and put it somewhere else. It's just not going to happen for 99% of investors. The EQT funds, they remove the emotion, the guesswork, and they remove that whole timing of the market piece. It's just done automatically for you, so you don't have any say in it, and that's what's best for most investors. So, which ETF is going to build the most wealth? The honest answer is, it really depends. It depends on the future. And since we don't know the future, the best thing to do is to choose an EQT fund and remain balanced. If the US keeps outperforming, then VFV will likely take the cake and have higher returns. However, if there's a global rotational shift in investment or profits, which is likely to happen at some point in the future, then the EQT funds are going to be the ones that shine brighter and deliver the higher returns. But if we take into account risk-adjusted returns, discipline, and ease of use, the EQT funds are going to be the ones that will provide the most sustainable wealth for most people. The EQT funds help you stay invested, avoid tinkering with your portfolio, and keep you holding through every single market cycle. And that's the true secret to building wealth over time. So here's my blunt take. If you're an experienced investor that understands exactly how VFV works, what it invests in, what the risks are, including currency risks, then go ahead. You know what? VFV would be a great option at that point. It's simple, it's proven, and as I said, it's low cost and trusted by many people. However, if you're a long-term investor that wants a globally diversified portfolio and you kind of just want to set your investment and forget it, then definitely the EQT funds are the way to go. And once again, it doesn't matter which one you pick, as long as you pick one of those funds. All of the EQT funds that I mentioned are all solid, and it really comes down to a little bit of personal choice, but the differences are very slight variations. So just pick one that you like and stick with it. Like I said before, every time I go online, the same sort of questions are always popping up. There are endless questions about which fund, how about that fund, what should I do with this fund now? You know what? My advice is to just stop searching for the perfect fund. Find one that aligns with your goals, keep that fund, and continue to invest in it. Whether that's VFV or one of these EQT funds, the only bad choice is the choice of doing nothing. And if you've got questions about this comparison, drop them in the comments for me. I'll be happy to address them. Thanks for watching Snackable Wealth, where I provide you with blunt and honest Canadian finance content. And remember, the best ETF is not the one that sounds the smartest or is the most popular. The best ETF is the one that you stick with. Until next time, see ya.